The most common Bollinger Bands mistake destroys mean reversion traders within weeks. They short every upper band touch and buy every lower band touch, treating the bands as automatic reversal zones. In a ranging market that works, the bands DO contain price and price does mean revert. In a trending market, price walks the band, it rides the upper band higher for 10, 20, 30 bars, while the short trader stacks losses on every touch. Today, the regime test that separates range from trend, the squeeze setup that actually has an edge, and how to trade Bollinger Bands with Confluence instead of blind mean reversion. Here's the regime framework. Bollinger Bands behave completely differently in three regimes. In a range flat price, no clear trend, touches of the upper band tend to mean revert back to the middle band, and lower band touches do the same. Fading those touches is the textbook mean reversion trade, and it works. In a trend, clear higher highs and higher lows, price walks the band. The upper band becomes dynamic resistance that gets repeatedly touched without reversing. Shorting those touches loses money. In a squeeze, bands compress together, you have neither regime, you have a pending breakout, and the trade is the expansion that follows. Watch this in a synthetic strong uptrend. Higher highs, higher lows, price walking the upper Bollinger Band for 30 bars. A mean reversion trader sees the upper band touches and shorts each one. Touch 1, stop out. Touch 2, stop out. Touch 3, stop out. By touch 10, they've lost more than they had to lose. The band wasn't resistance. It was the upper edge of a trend channel that price was riding. Same trader fading the lower band in a downtrend gets identical treatment. Mean reversion without regime awareness is account suicide. Here's the trade that actually works in either regime. The squeeze. When the Bollinger Bands compress to historically tight width, narrower than they've been for 20 or 30 bars, volatility is at a low. By the mean reverting nature of volatility, expansion is coming. The direction is unknown until the break, but the expansion itself is high probability. Wait for the first close outside the squeeze, take that direction, and ride the expansion to the next significant level. That's the Bollinger setup with the highest expected value, not band touches in random regimes. Now the real Bollinger trade. Price consolidates tightly, bands compress to historic narrowness. Volatility is silent. Then the first wide range candle closes outside the compressed bands. That's the entry. The trader takes the direction of the break, sets a stop on the opposite side of the squeeze range, and targets a measured move equal to the prior trading range. The expansion is what you wanted. The band touches in random regimes were never the trade. Squeeze plus break, repeatable, mechanical, edge. On a real chart, run the regime check first. Is price clearly trending? Walk the band, don't fade touches. Is price ranging? Mean revert, fade touches with confirmation. Are bands squeezed? Wait for the break and trade expansion. The Bollinger setup that works depends entirely on the regime, and the regime is visible before you click. 3 different setups, 1 indicator. Pick the one that matches what you see. So, Bollinger Bands have 3 completely different setups depending on regime. Mean revert in ranges, ride the band in trends, trade expansions out of squeezes. Shorting every upper band touch regardless of regime is the most common and most expensive Bollinger mistake. Subscribe for the full method and trade your own plan. Education, not financial advice.